shares at price X, but couldn't actually do so because speculators had shorted the stock. So they enter into financial engineering, the result of which is a so-called true sale at Y price, thus forcing upon them, rather, the profit which they couldn't possibly have enjoyed had they really gone ahead and sold. Surely that has to be true lies. I'm going to move on and go into structured products and high net worth individuals. In 2004, the extent of Citibank's mis-selling of structured products was so bad it resulted in the closure of their Japanese private banking business. In September 2004, Japan's FSA reported that the private banking business performed a number of acts injurious to public interest, including extremely inappropriate transactions, including selling structured products to high net worth clients without a full explanation of the risks involved, without assessing the suitability of customers to buy those products in some cases. That may sound familiar. Closer to home, we've seen plenty of pain and suffering in the local equity market. And not only the cash market, where losses have actually been directly reflecting the falls of share prices. Plenty of our professional investors in Hong Kong, so-called because they've got $1 million in the bank, have been lured into the dreaded accumulator product, termed, as I'm sure you know, I'll kill you later, because it does. And for those of you who haven't studied any term sheets for accumulator contracts, they're under 15 pages. If you read them less than 5 times, you probably don't understand them. I know I don't. But once you've read them 5 times or more, you realize that the accumulator is a pretty dangerous product. It's a combination of a series of forward contracts, a series of call options, and a series of European-style put options. The problem is that all of these are structured together, and the bank is on the other side of the bets. You're betting against the bank. You're betting against your bank. The definition of professional investor is obviously less than satisfactory. There are more issues involved than simply knowing how much your client has got in the bank, because you need to monitor the impact of the product on the client. And knowing what your client has and monitoring the impact of what the product has on the client's position is one thing you cannot afford not to do. The SFC's Code of Conduct requires at paragraph 5.2, and this applies to all investors, this requires advisors to take the same basic fundamental approach towards investors, be they large or small. The Code of Conduct requires them to have regard to information about the client of which the licensed or registered person is or should be aware through the exercise of due diligence. They've got to ensure the suitability of their recommendations or solicitations are reasonable in all the circumstances. And at 5.3, and this is particularly important where leveraged or derivative products are concerned, they must ensure that clients have got sufficient net worth to be able to assume the risks and bear the potential losses from the product. So in short, what the banker has to do is ask themselves, does the client understand the nature of the product? Does the client understand the product's risks? And has the client got enough net worth to bear the potential losses? Now, the last of these, has the client got sufficient net worth, is a very objective test. Either the client has or has not. And if a bank has done its due diligence and established the extent of a client's net worth, then fine, they've met the requirement. But in many cases, they have not. However, as I said, the SFC's codes of conduct require something rather more fundamental. And it matters not that terms and conditions try to put the onus on customers if the code of conduct is requiring as a fundamental that the banks understand that products are suitable and that the client understands the risks and has the wherewithal to meet those risks, then those requirements have to overcome whatever else is in the private contract with the bank. Couple of moments only on securitizations. I realize we're running out of time. In simple times, banks took custody of deposits, they lent to business and personal borrowers, and their objectives were very simple. They had to make sure there was a sufficient reserve ratio to meet withdrawals, and they had to monitor customers' ability to repay interest and to repay principal. As long ago as 1776, Adam Smith remarked that the directors of companies, being the managers of other people's money rather than their own, it can't be expected they would watch over other people's money with anything like the same anxious vigilance with which the partners in a private partnership would watch over their own. Negligence and profusion, he says, must always prevail in the management of affairs of such companies. Now, that was in 1776, 60 years before modern company law was even dreamt of. So his starting point is that managers are apt to be negligent and extravagant. And if you look across the page, you see not much has changed. The bankers who were able to afford, or their bank was able to afford, a £44,000 lunch in London. It's probably a good example of the excesses to which the financial services sector has gone. The impact of securitization, in a nutshell, has enabled banks to pass away from their balance sheets and put into securitized form all sorts of investment risk and constantly push that into the market. And instead of constraining their balance sheets with a certain amount of money which they could prudently manage, and instead of taking over the job of watching the repayment obligations and monitoring the debts, all that gets passed over to investors like you or I, who are buying securities of this nature and don't actually understand whether or not the risk of people able to service their obligations to banks is actually being met. And that led, in 1992, a former head of market regulation in the SEC, William Hayman, to remark that in manufacturing, the market price is set by the smartest guy with the best, cheapest production process. But in securities markets, the price is set by the dumbest guy with the most money to lose. The effect of securitization on banks has meant not just problems for their clients, their shareholders are also losing out big time. And anybody who held shares in Fannie Mae and Freddie Mac, as I said at the beginning, their shares are now worth absolutely nothing. Thank you very much.